Why do we believe that this time will be different? Why do we assume that the rules of economics have suddenly changed? Why do millions ignore the warning signs until it's too late to act? Because hope feels safer than preparation. Because denial is more comfortable than facing hard truths. Because we trust the system until the system stops working. But here's the reality. Every financial collapse in history was preceded by the same confident statement. This time is different. The market has fundamentally changed. We've learned from past mistakes. And every single time, those words became the most expensive lies people ever believed. So let me ask you something simple. If today you decided to sell your house, would a buyer actually show up? Not in theory, not on paper, not based on last year's valuation, but right now in this market with real money on the table. If the answer is maybe, then the risk is already inside your financial life. This video is not about predicting when the crash will happen. This video is about understanding why crashes happen and who survives them. Because when history repeats itself, and it always does, the biggest losses belong to those who stood on hope. Not on planning, not on preparation, just on hope. Every financial bubble in history follows the exact same physiological and economic pattern. It starts with real growth, then transitions into artificial inflation, and ends in collective denial. Here's how you know a bubble is forming. Prices are rising much faster than people's actual ability to pay for them. Debt is treated as normal income, not as borrowed time with interest attached. And the majority of people around you genuinely believe that this is the new normal. They say things like, real estate always goes up. You can't go wrong with property. Everyone I know is buying, so it must be safe. But here's the truth they don't want to hear. A house is only an asset when someone is willing to buy it from you. If there's no buyer, then the value you see on paper is just a number. It's not wealth, it's not security, it's a hope wrapped in a mortgage payment. And when the system shifts, hope doesn't pay the bills. Cash does, liquidity does, the ability to survive without selling does. The surface looks stable because everyone is still making payments, still getting loans, still moving forward. But beneath the surface, the foundation is cracking. Debt levels are unsustainable. Income growth is stagnant. Buyer demand is weakening. And when those three forces collide, the appearance of stability disappears in weeks, not years. This isn't a prediction. This is pattern recognition based on documented economic history. Let's go back to 2006 and 2007, right before the global financial crisis hit. What were people saying back then? The exact same things they're saying today. The housing market is rock solid. Banks wouldn't give loans if it wasn't safe. Jobs are stable, the economy is fine, everything is under control. And then 2008 arrived, and millions of people lost their homes overnight. Not because they were reckless, not because they missed payments intentionally, but because the entire system they trusted collapsed beneath them without warning. Here's what most people don't understand about 2008. The majority of people who lost their homes were making their payments on time. They were doing everything right according to the rules they were given. But the problem wasn't individual responsibility. The problem was systemic risk. When credit markets froze, banks stopped lending to anyone, no matter how responsible they were. When home values dropped, people owed more than their houses were worth. When jobs disappeared, even good payments became impossible to maintain. And here's the cruelest part. Banks don't care about your story. They don't care about your intentions or emotions. When the system is under pressure, banks protect their cash reserves first. Everything else, including your family's home, becomes a line item to be liquidated. This isn't opinion. This isn't speculation. This is documented, verifiable, historical fact. The question isn't whether it can happen again. The question is whether you'll be ready when it does. Now let's look at an example that most people in the West completely ignore: Japan. After the asset bubble burst in the early 1990s, property prices in Japan collapsed. And here's the part that shocks people. Those prices didn't recover for 20 years. Some areas still haven't fully recovered today. People owned houses, they had title deeds, they had mortgage statements, but they couldn't sell. There were no buyers, there was no market liquidity. On paper, they owned an asset. In reality, they owned an obligation with no exit. They were trapped, paying for something they couldn't convert back into cash. This is the brutal truth about asset markets during prolonged downturns. Ownership without liquidity is not wealth. It's just responsibility with no return. And the fundamental rule of finance that Japan's example teaches us is this: when cash becomes king, when people hoard liquidity instead of spending it, assets go silent. They don't sell, they don't move, they don't generate the returns people expected. Japan's experience wasn't unique because of culture or geography or policy mistakes alone. It was the natural result of asset prices rising far beyond what incomes could support. When that gap becomes too wide, correction is not optional, it's mathematical. So let's bring this forward to today, to the current moment we're living in. What are the signals we're seeing right now that mirror past crises? First, property prices in many markets are at historic highs relative to median incomes. Second, income growth for the average worker has been slow or flat for years. Third, lending standards have tightened, making it harder for new buyers to enter the market. Fourth, buyers are becoming more selective, waiting longer, demanding better deals. None of these things individually guarantee a crash, but together they create systemic pressure. And systemic pressure doesn't announce itself with headlines or warnings from central banks. It builds silently, accumulates gradually, and then breaks suddenly at the weakest structural point. Here's what most people don't understand about financial crashes. They don't happen because everyone suddenly panics at the same time. They happen because pressure builds to unsustainable levels, and then one small trigger releases everything. It could be an interest rate change, a major employer shutting down, a bank failure. The specific trigger doesn't matter. What matters is that the pressure was already there. And right now, in this moment, that pressure is building again. Not in every market, not in every country, but in enough places to matter. And when pressure reaches critical mass, it doesn't politely stay contained in one area. It spreads, it connects, it cascades through systems that are more linked than people realize.
When a crash comes, it doesn't affect everyone equally. Some people walk away relatively unscathed. Others lose everything they built over decades. So who gets hit first? History gives us a very clear answer. The first to fall are those who entered the market with minimal down payments. They have almost no equity cushion to absorb even small declines in value. The second to fall are those who pushed their monthly payments to the absolute limit. Their EMIs or mortgage payments consume such a large percentage of income that any disruption breaks them. The third to fall are those who built no cash buffer, no emergency reserves. When unexpected expenses arrive or income drops even slightly, they have zero margin for error. Here's why this matters. When income shifts, even by 10 or 15%, the pressure doesn't distribute evenly. It falls entirely on the largest fixed obligation in most people's lives, the house payment. And when you can't make that payment, banks don't negotiate based on your circumstances. They look at the numbers. They look at the contract. They look at their own risk. Everything else is irrelevant to the decision-making process. This isn't cruelty. This is how financial systems operate under stress. Understanding this reality is the first step toward protecting yourself from it. So, if traditional assets become traps during downturns, What actually holds value? What survives when markets collapse and confidence disappears? Asset number 1, cash and liquidity. Cash doesn't give you impressive returns. It doesn't grow 10% per year. But cash's real job isn't to generate returns. Cash's job is to buy time. Time to wait, time to think, time to make decisions without desperation. When everyone else is forced to sell, cash gives you the option to hold or buy. Asset number 2, skills and earning ability. The market can fall 30, 40, 50%. Your skill-based value doesn't fall with it. Your ability to solve problems, create value, and generate income remains intact. Skills can't be repossessed. They can't be margin called. They travel with you. In every downturn, the people who survive best are those who can earn regardless of conditions. Asset number 3, essential demand and utility. Luxury falls first and hardest. Needs survive and often become more valuable. Housing that people can actually afford. Services that solve real problems. Essentials, not extras. Downturns don't reward hype, speculation, or status symbols. They reward utility, practicality, and things people genuinely cannot live without. These 3 assets, cash, skills, and essential utility, form the foundation of crisis resilience. They're not exciting. They don't make you feel rich on paper, but they keep you standing when everything around you is falling. Now let's talk about the mistakes that turn manageable situations into complete disasters. Mistake number 1, denial and false exceptionalism. "This time is different" is the single most expensive sentence in financial history. Every generation says it, every bubble believes it, and every crash proves it wrong. Mistake 2 is over-leveraging and treating debt as income. Debt amplifies everything. It takes you up faster and it takes you down faster. When leverage works, you feel like a genius. When it breaks, you lose everything. Mistake 3 is panic selling at the bottom. Whoever sells in panic is transferring wealth to someone buying with discipline and patience. Panic decisions are almost always the wrong decisions, but they feel urgent in the moment. Mistake 4 is ignoring cash flow and focusing only on paper value. Asset values can fall 50% overnight. Your monthly expenses don't fall at all. If you can't cover your obligations with actual cash flow, paper value is meaningless. Mistake number 5 is waiting for perfect clarity before taking action. When clarity finally arrives, when everyone agrees the crash is real, options are already gone. The time to prepare is when things still look fine, not after the damage is done. These mistakes aren't made by stupid people. They're made by normal people under pressure. The difference between surviving and failing often comes down to recognizing these patterns before acting on them.
So, what does actual preparation look like? Not theory, not vague advice. Concrete steps. Step 1. Document your real income versus your real expenses. Write it down, track it. Know exactly where you stand financially at all times. Step 2. Build 6 to 12 months of cash reserves. Not invested, not in the market. Actual accessible cash that can cover essential expenses. Step 3. Reduce or eliminate all high-interest debt immediately. Credit cards, personal loans, anything charging double-digit interest is a ticking bomb. Step 4. Stress test your income against realistic worst-case scenarios. What happens if your income drops 20%, 30%? Can you still survive? Step 5. Defend your monthly expenses and cut everything that isn't essential. Subscriptions, luxuries, anything that doesn't directly support survival or income generation. Step 6. Build optionality through skills, side income, and alternative revenue streams. Don't depend on one job, one client, one source of income if you can avoid it. Temporary discipline prevents permanent damage. Temporary discomfort prevents permanent loss. The people who survive crashes aren't smarter, they're just more disciplined before pressure arrives. Let's talk about how smart money actually operates during crisis periods. Not how it talks, not how it appears, how it actually behaves. Smart money is not loud. It doesn't announce its moves on social media. It doesn't need validation or attention. It acts quietly and consistently. Smart money doesn't try to predict the exact bottom of the market. It knows that perfect timing is impossible, so it focuses on ranges and probabilities. Smart money moves in phases, buying gradually over time instead of all at once. It averages in, tests positions, and adjusts based on what actually happens. Smart money focuses on quality over quantity, preferring one strong position over 10 weak ones. It values downside protection more than upside potential during uncertain times. And smart money turns patience into an asset, understanding that waiting costs less than mistakes. It's willing to hold cash and do nothing while others panic into action. This isn't a secret group of insiders. It's simply a difference in behavior and mindset. Smart money isn't special. It's just more disciplined and less emotional than average money. Eventually, every crash ends. Every downturn transitions back into recovery. But here's what most people miss. Recovery begins before the headlines say it does. The signs of early recovery are subtle and easy to overlook if you're not watching. Signal 1. Volatility decreases. Wild daily swings start to calm. Price movements become more predictable and less extreme. Signal 2. Prices stabilize. Assets stop falling and start forming a base, even if they're not rising yet. Signal 3. Credit slowly returns. Banks start lending again, cautiously at first, but the flow of money resumes. When you see these signals, how should you move? Move in small steps, not big leaps. Test positions. Take partial actions. Don't commit everything at once. Spread actions over time. What you buy today might be cheaper tomorrow, but that's fine if you're averaging in. Never go all in. Keep reserves, maintain optionality, preserve the ability to act again if needed. Recovery is not a race to the finish line. It's an endurance test of patience and discipline. The people who win in recovery aren't the fastest movers, they're the most consistent. The last lesson that every market cycle teaches us is this. A crash tests your courage and your ability to stay calm under pressure. Recovery tests your character and your ability to act when others are still frozen. Those who stand only on hope repeat the same cycle over and over again. They ride the market up, ride it down, and end up back where they started. But those who make decisions based on understanding, on preparation, on discipline, after every cycle they come out stronger, wealthier, and more resilient than before. This isn't luck. This isn't insider knowledge. This is simply the difference between reacting and planning. If you want a printable checklist of these survival steps or the next deep dive in this series, save this video, share it with someone who needs to hear this, and write "ready" in the comments.